In this video, we're going to learn what shorting is. Essentially, shorting is a way of making money when the price of an asset decreases. In other words, it's kind of the reverse of going long in a stock. Because when you go long in a stock or buy a stock, the only way you can make money is if the price of the stock increases. When you short a stock though, the only way you can make money is if the price of the stock decreases. And this can seem quite counterintuitive to most people, but it does make sense once you understand the process. Ultimately, shorting involves selling an asset that you do not own and then buying it back when the price decreases. So you receive some funds first by selling an asset, and then you buy it back when the price decreases. So your profit is then the difference between what you sold it for and what you bought it back for. How do you sell an asset you don't even own? Well, you borrow it. So if we think about the shorting process, if we have a timeline over here, what we're saying is that at some time t0, you borrow some shares at a high price, and then at the same time, at t0 as well, you sell the shares at the same high price, or at least close to this high price. And then at some point in the future, you buy back the shares at a lower price, and then return these shares to the original lender. Now, of course, if you can't buy back the shares at a lower price, you still will need to buy them back and return them to the lender, because at some point you'll need to close your position, and so that might well mean that you end up making a loss. But more on that in a bit. Let's just make sure we really understand this process. So what we're saying is that you borrow some shares from, say, your broker, and that will of course attract some sort of fee or interest, and then pretty much as soon as you borrow the shares, you sell them to someone else, take the proceeds, and invest them in a risk-free security. So that might be something like a government bond. And then once the price of the stock decreases, you buy it back from the open market and return the shares to your broker, including any interest payable. Let's go ahead now and see what this process looks like with an example. So imagine that today is the 18th of Jan 2018, so we're here as of this date, and then we have this 6-month price forecast of Amazon Incorporated. So we think the price of Amazon can either go in this trajectory, where it goes upwards to sort of 1800, or it can go down on this trajectory, where it goes down to roughly about $1,000. Now, if you look closely, you'll see that for the first 3 months, the expected decrease of the price is greater than the expected increase of the price. And for the next 3 months, so from month 4 through to month 6, the expected decrease in price is lower than the expected increase. So what do we mean by this? Well, as of today, the 22nd of Jan 2018, the price is at about $1,300, right? And then 3 months later, sort of here, we're saying the price could be down to $1,000, or it could be up to about $1,500. So if we were to plot this 3-month scenario in a separate timeline, then we might have something like this. Right, so we're saying we're here today where the price of Amazon is $1,300, and then 3 months later the price could either go up to $1,500 or it could go down to $1,000. And the difference in the price, so here we're going from $1,300 down to $1,000, which is $300 difference, and here we're going up to $1,500, but that's only a $200 difference. So what we're saying is the expected decrease of the price is greater than the expected increase of the price. And if we believe this forecast, then it might make sense for us to go ahead with a short strategy. So let's consider what this might look like. Again, we have our timeline, and we're saying at t0, so today, we might borrow 100 shares at $1,300 each. So that would take us to a value of $130,000, because we have 100 shares at $1,300 each, so that's 130K. And we're saying that we borrow the shares at 3% per year for 3 months. So for 3 months, that will work out to 0.75% interest. And we expect to pay our broker $975 3 months down the line. Then what we're saying is, as soon as we've borrowed these shares, we're going to sell them in the open market and invest the proceeds in a risk-free asset earning some interest. Right? So we're assuming you're going to earn 2% interest, and 2% annual interest works out to about 0.5% interest quarterly. So we're going to take the $130,000 that we got from selling the shares, and we're going to invest it in a risk-free security or a government bond that's going to pay us 0.5% interest at the end of 3 months. Now, 3 months down the line, assuming the price of Amazon did actually decrease to $1,000, we would buy back 100 shares at $1,000 each. So we would spend $100,000 and buy back all of the shares that we borrowed, and then return the shares at the current market value of $1,000 each to our broker. Now recall that we borrowed shares worth $130K, we sold them, so we received $130,000 in cash, which we invested in the risk-free security, and then 3 months down the line we took the funds, plus any interest, and used the funds to buy back these 100 shares at the new lower market price of 100 grand. So we've made a profit then of 29,675 because we received 130K at T0, we spent or paid 100 grand, that takes us to 30K, and then we paid $975 in interest, but we also received $650 in interest. So the net interest that we paid was $325. Take away the $325 and you end up with a profit of $29,675. Not bad. Now, of course, this profit is based on the price of Amazon actually decreasing to $1,000. But if you recall, according to our forecast, the price may well have gone up to $1,500. And if that happened, then our short would have gone quite wrong. So let's consider what that might have looked like. Well, we would still borrow 100 shares at $1,300 and sell the 100 shares at $1,300 as well. But then instead of buying it back at $1,000, we would now buy it back at $1,500 and then return the shares to the lender or the broker at the current market value of $1,500 each. And if we went through the numbers again, what you'll find is that we end up making a loss of $20,325. In this particular example, it looks like the gains, or the potential for gain, is still higher, right? Because we showed a profit of $29,675, but a loss of just $20,325. But importantly, by no means are we in any way whatsoever suggesting that the potential for gains are greater in a short position relative to the potential for losses. The key takeaway here is that shorting is actually incredibly dangerous, and you want to be really sure of exactly what you're doing if and when you decide to go for a short. And that's because when you go long, for example, the maximum amount you can lose is your investment, because the price of stocks are bounded at the lower end by 0. You can't have negative prices. But the maximum you can gain is theoretically infinity, and that's because stock prices can theoretically increase to infinity. There's no upper bound to stock prices, but there is a lower bound in that it can't trade below 0. When you short a stock, however, remember that you make money from the price decreasing, and given that the lowest a price can go is 0, the maximum you can gain is the price you sold it for. Because if you sold shares for, say, $100, the maximum you can make is $100 because the price can only decrease to 0, and so in that case, you would have made a profit of $100. But the maximum you can lose is, at least theoretically, infinity, and that again is because while stocks can never be worth less than 0, they have absolutely no upper bound or upper limit, and so the maximum amount you can lose from a short position is, at least theoretically, infinity, because the price of a stock P is always going to be bounded by 0 at the lower end, but the upper bound is infinity. Alright, in summary then, we learned that shorting is a way of making money when the price of an asset decreases. It involves borrowing and selling a stock at a high price and then buying it back and returning the stock at a lower price, with the profit being the difference between the sell and the buyback price. Importantly, the maximum you can gain from a short is the price at which it was sold for, but the maximum loss for a short is, at least theoretically, as high as infinity. That's enough from me for now. Have a go at the quiz, and I'll see you in the next video.